Good afternoon and welcome back to class. In this tutorial, I will solve 12 past examination objective questions covering the final account of a sole trader. This lesson is designed to help students preparing for examination in accountancy or in accounting. Watch the end and test your understanding of the fundamental principle of accounting. Question 1. Question 1 reads, an example of a non-cash expense shown in the statement of profit or loss account is A. Telephone, B. Transportation, C. Depreciation, D. Stationery. Now, a non-cash expenses is an expenses that cash is not spent. Telephone is an expenses where cash is paid. Transportation, cash is given out. Depreciation, cash is not given out. And stationery, cash is given out. So the correct answer there is depreciation. A depreciation reduces profit but does not involve actual cash payments. Depreciation reduces profit but does not involve actual cash payment. So the correct answer there is depreciation. The correct answer there is depreciation. Now let us try to find out other non-cash expenses that are actually found in account. There are other non-cash expenses that this question can be asked and the depreciation is not there and they will put in other non-cash expenses. Other non-cash expenses are amortization. Amortization is a non-cash expenses. Depletion is a non-cash expenses. And impairment also. Impairment losses are non-cash expenses. Bad debt written off is also a non-cash expenses. Our provision for doubtful debt is also a non-cash expenses. So should they ask this question and there is no depreciation, they may put these options. Amortization, a non-cash expenses. Depletion, a non-cash expenses. Impairment, a non-cash expenses. Bad debt is also a non-cash expenses. Provision for bad and doubtful debt is also a non-cash expenses. Question 2. Why are adjustments in the profit and loss account necessary? A. To cover some expenses of the following year. B. To ascertain the actual expenses incurred and income earned during the year. C. To show the provision made during the year. And D. To show the provision made after the year. Adjustment ensures the accrual concept is applied so that income and expenses relate to the correct accounting period. So the right option there is option B. To ascertain the actual expenses incurred and income earned during the period. So option B is the correct option. Question 3. The capital of a sole trader can be increased by debiting the capital account, crediting the capital account, debiting the cash account, crediting the cash account. Now, from a simple logic, from the logic of the accounting equation, I've said is equals to what? Liability. Assets are increased by the debit side and decreased by what? The credit side. Then liability and capital increases by the credit side and decreases by what? At the debit side. So to increase the capital of a sole trader, it should be, the capital of a sole trader can be increased by crediting the capital account, because capital account increases by the credit side. So the correct option here is option B, crediting the capital account. Now this is question 4. Question 4 says, use the following information to answer the questions below. Says 14,600, purchases 5,500, sales return 1,500, rent is 2,000, salary is 1,000, discount received is 400, closing stock is 250, while opening stock is 100. And the first question there says, the net sales is, now the net sales is sales minus sales return. And the figure of sales there is 14,600. And the figure of sales return there is 150. So the sales return is 14,600 and minus 150, and that will give us 14,450. And in the options we have A, 15,099, 1,750, 14,600. And the correct option now is option D, which is what? 14,450, which is 14,600 minus 150, which is what it says return. Question 5. The cost of goods sold is, the cost of goods sold is opening stock plus purchase less closing stock. The opening stock here is 100. Purchase is 5,500. And the formula for calculating the cost of goods sold is opening stock add purchase less closing stock. So what we are going to have here is 5,600 minus 250. That is 5,500 is the purchase. Opening stock is 100. Purchase is 5,500. That will give us total of 5,600. 5,600 minus the closing stock. The closing stock there, which is this. The closing stock there is 250. So 5,500 minus 250. So what we use in this computation is one opening stock plus purchase, then less closing stock, and we will have 5,350. So let us go to the option and see whether we have 5,350. Option A is 5,350. So option A is the correct answer. Now, question 6. The gross profit is, now the gross profit formula is a net sales less cost of goods sold. Now we have calculated the cost of goods sold to be 5,350, and our net sales is 14,450. So our gross profit now becomes 14,450 minus cost of goods sold. The cost of goods sold is 5,350, and by the time you do the mathematics, you will have 9,100. So the cost of goods sold is 9,100. Option A, 9,100 is the correct option. Question 7. What is the effect if closing stock is overcast by 100? What is the effect if closing stock is overcast by 100? Option A, gross profit will increase by 100. Option B, net profit will reduce by 100. Option C, cost of goods sold will increase by 100. Option D, goods available for sale will increase by 100. So let us analyze it. Now, when closing stock is overcast by 100, that will reduce the cost of goods sold, and the cost of goods sold will reduce by 100. And if the cost of goods sold reduced by 100, that invariably means that the gross profit will increase by 100, and the net profit will also increase by 100. So the option A there is correct. When closing stock is overcast by 100, that will reduce the cost of goods sold by 100 and will increase the gross profit by 100. So option A is the correct option there. Now question 8. When a buyer is overcharged, the seller forwards a debit note, B, a credit note, C, an undercast note, D, payment receipts. Now, a debit note and a credit note. A debit note is usually issued either by the seller or by the buyer. If it is issued by the buyer, then the buyer is reporting overcharge. And when a debit note is issued by the buyer is reporting an overcharge to the seller. And the seller will respond after verifying the overcharge with a credit note. Now, if a debit note is issued by the seller to the buyer, that means the seller is reporting an undercharge. And when the buyer verifies the undercharge, we issue a credit note to the buyer acknowledging the undercharge. That is the relationship. Now, when a buyer is overcharged, the buyer will now forward a debit note to the seller. And when the seller acknowledges the overcharge, it will now forward a credit note back toward the buyer. So when a buyer is overcharged, the seller forward a credit note. So option B is the right answer. The seller will forward a credit note to the overcharged buyer to acknowledge the overcharge. Question 9. When goods are purchased on account, The accounting entries are A. Debit the purchases account, credit the suppliers account. B. A debit bank account, debit purchases account. A credit bank account, debit purchases account. And D. A debit bank account, debit purchases account. Now, let us look at the question critically. When goods are purchased on account, underline this word on account. On account means that goods are purchased on credit. When goods are purchased on account, it means that the goods is purchased on credit. And when good is purchased on credit, two accounts that are involved is the purchases account and the creditors account. And the creditors account or the supplier account increases by the credit side, while the purchases account increases by the debit side. So, when good is purchased on account, the right entry there is to debit the purchases account and credit the supplier's account. The supplier in this case is now the creditor. So, debit purchases account and credit supplier's account. And that is the right option. A is the right option. When goods are purchased on account, it means that the good is purchased on credit. Question 9. That's question 9. That's question 9. Then question 10. Question 10. An account is said to have a debit balances because the first entry made in it is on the debit side. B. There are more entries on the debit side than on the credit side. C. Total value of debit entry are more than the total value on the credit entry. D. There is no entry at all on the debit side. Now there are two options that is close to the answer. That is option B and option C. There are more entry on the debit side than on the credit side. I know some students will choose this, but it's not the number of entry that matters. It's the value of entry. So the answer to this question is C. The total value of debit entry are more than the total value of credit entry. And so the right option there is option C. Question 11. The double entry for increasing the provision for bad debt is debit. I take it once more. The double entry for increasing the provision for bad debt is debit. A. Debtors account, credit provision for doubtful debt account. B. Profit or loss account, credit debtors account. C. Debit debtors account, credit profit or loss account. And D. Debit profit or loss account, credit provision for bad debt account. Now, the double entry for increasing, when there is increase in the provision for bad debts, that means the difference is an additional expenses. And so we need to debit the profit and loss account. When provisions are increased, it increases the expenses, and the expenses are treated by the debit side of the profit or loss account. So the double entry is to debit the profit or loss account by the increase, and credit a provision for bad debt accounts. Provision for bad debt accounts is a revenue account. It has increased. An increase in revenue item are on the credit side. So the correct entry is to debit the profit and loss account by the increase and credit at the provision for bad debt account also by the increase. So the correct option here is option D, which is debit profit or loss accounts, credit provision for bad debt accounts. Yes. Now question 12. The double entry for decreasing the provision for bad debt is to debit. Yes. Now when the provision for bad debt is reduced, it becomes a revenue item. That is why we add this revenue to the credit side of the profit or loss account. So when provisions of doubtful debt are reduced, it becomes a revenue item. Let us look at the option. You see, the double entry for decreasing the provision for bad debt is to A, debit provision for bad debt accounts, credit profit or loss accounts. B, debit profit or loss accounts, credit provision for bad debt accounts. C, debit debtors account, credit profit or loss accounts. And D, debit bank account, credit trading account. Now, when there is a reduction in provision, it becomes a revenue item, and so is to go toward the credit side of profit and loss account, and the provision itself had to reduce, and to reduce provision account, which is a revenue account, or revenue account increases by the credit side and decreases by the debit side, and to decrease it, we have to debit the provision for doubtful debt account. So the correct entry here is to debit. The current entry here is to debit profit and loss account. Let me see. Provision is said to debit provision for doubtful debt account and credit profit and loss account. That is option A, and that is the correct option. Option A is the correct option. Now, test yourself with this question. Test yourself. There is need for you to test yourself to know whether you are flowing with us. Question 1. Which of the following is a capital expenditure? A, salary and wages. B, stationery, a repair of motor vehicle, purchases of furniture. Question 2. Apart from depreciation, can you mention another example of a non-cash expenses in accounting? Do you know it? Question 3. If sales is 20,000 and sales return is 500, what will be the net sales? Can you answer it? Question 4. What happened to gross profit if closing stock is understated? Did you remember how we treated when closing stock is overstated? Can you use that logic to answer this question now? These are potential examination questions, so do not run away from them. Question 5. Which account is credited when goods are purchased on credit? Did you remember? Will you go back to the tutorial and try to find out the account that will be credited when goods are purchased on credit. When goods are purchased on credit is the same thing as when goods are purchased on accounts. Question 6 and the final question. Why is provision for bad debt necessary in financial accounting? These are potential questions from you. These are the questions you will ought to answer at home before you go to the examination question. Drop your answer in the comment section. Let's learn together. Don't forget to like, share, and comment on our tutorial. Thank you for learning with us. Bye.